But now looking at the global factors impacting markets from wheat to carbon and beyond, we turn to Martin Crabb from Shaw and Partners. Welcome, Martin. Thanks for coming to the show.
Good to be here.
Good to hear. So let's talk. I saw wheat on there. The ag space is something we've been talking about a lot today. What have you come to the show with us in terms of insights? Because it seems to me a very hot space, and one, if you even just zoom out from where we are with all the current supply shocks and geopolitical ructions, a secular theme on food security for the next decade.
Yeah, so we were lucky enough to host the management team from Elders in our boardroom for a breakfast this morning. Our analyst Phil Pepe has been quite positive on that stock and just continuing that theme of a stronger for longer ag cycle. So as most viewers would know, rainfall up and down, droughts up and down. Farming's not a linear sort of business. It kind of comes and goes, which means a lot of investors just don't go near it because you can have these booms and busts. But it does seem that the Aussie agricultural sector is in for a couple of years of very strong rainfall and very strong cropping. So difficult to play that as an investor on the market. There's not that many companies that are listed that give you an exposure to the overall health of the industry. Elders probably is one. So Elders is, it's one of Australia's oldest companies. It's basically the full service for a farmer, so everything a farmer needs, whether it's fertiliser, crop protection, fencing, machinery, and farmers, a little bit like stockbrokers, they tend to spend their bonuses. So if we've got a couple of very strong years for cropping in particular, farmers are flush with cash, they go out and upgrade. So it's difficult to get yellow gear at the moment, it's difficult to get tractors and stuff because of supply chain issues. So we think the capex will be on things like fencing and stuff like that. So Elders are really well placed to capitalise on that. Most analysts have got their earnings falling away because this year's going to be so good. But what we heard from Malcolm Jackman and the team this morning was that a continuation of these conditions could last for a couple of years. So very, very bullish outlook for the sector.
Just in terms of the Australian ag space, and I suppose Elders would have given you a few good insights as well, is that there are those environmental factors that we deal with here, and they sort of push and pull. You've got the climate change story as far, and that ties back into the food security story. You go into the geopolitics of it as well. Yeah. That's been highlighted with Ukraine, but of course, we do have these sort of disruptions in the environment from things like climate events that disrupt crops, affect production. Where do you sit there in terms of, as an investor, gauging those sort of push and pull factors? Is it on balance a sort of a net positive because of the first set of factors that I mentioned, or does it come with some very big inherent risks because of the potential of, again, the destruction of product?
Yeah, you're right. It's an incredibly complicated field because you can't just look at one factor and say, right, I'm an ESG investor, I'm not going to touch, chemicals or whatever. Yeah. I think the food security point you hit on, Kyle, is very, very important for investors because we need to think about ourselves primarily as protecting ourselves against inflation, right? So most of our customers, our clients, they're looking for long-term inflation-protected income streams. So when they retire, they know they can keep up with the standard of living. So if you do get food inflation and you do get fuel inflation, they're two big household inputs. So we need to kind of hedge them out. So what we're seeing right now with Ukraine and Russia being taken off the global grain market is we will potentially see food shortages. Australia's very well placed to help compensate for that, but again, it's very difficult as an investor. You can go and buy grain corp, but that's not really giving exposure to the wheat price, it's more the wheat crop. So, that's why things like Elders fit into a diversified portfolio really well. But I think investors need to think about, what am I doing in my portfolio to protect me against different kinds of inflation? I can go and buy Woodside and Sandoz to cover me for energy, but what about food? So we really do need to look at food producers, not just as like a normal stock, but as a hedge against potential inflation down the road.
Yeah, right. On the carbon point as well, does that tie into what you're sort of speaking about a little bit with exposure to the energy space and what have you, or what else is there to it that I need to know?
Yeah, carbon's really interesting, and it's something that I'm getting up the learning curve. I'm by no means an expert, but we hosted again, plugging Shaw and Partners here, we hosted an ESG call this morning at 8 o'clock, and we had 4 people from around the world talking to us about what's happening with carbon credits, carbon emission trading schemes. Obviously the change of government, and the voice of the Australian people was, we want more action on climate change. So it's something that's very topical, and investors can go and buy carbon offsets. There are liquid futures exchanges, particularly in Europe and North America, where people can go and buy carbon offsets. So when you travel on an airline, you usually ask, do you want to offset the carbon impact? What happens there is the airline will go into the market and buy an offset. They're not going to go and plant a tree, they'll go into the futures market. So there's a futures market there, therefore there's an exchange traded fund market that invests on the back of that. So you can go and buy carbon offsets in your portfolio. So we think that's a really good green way to buy energy. So rather than buying a company that's digging up coal or hydrocarbons, why not go and buy an emission offset credit in Europe or the United States? So that's what we've been doing.
Yeah, right. It sounds like maybe a sort of fairly nascent area, at least for Australian investors.
It's very new, but it's going to be massive, right? Because if we're going to get to our 2030 and 2050 targets, people have got to buy a lot of emission offsets. So that market's only going to grow. And I think the regulations behind the market, I think companies and super funds are moving much faster than regulation. And obviously with the change of government and the Greens playing a much more important political role, I expect you're going to see regulation catch up pretty quickly.
That's interesting. So one to watch there. I can't let you go. I've got time for one more question. Just more of a broader market view at the moment, because we have had this sort of rally in US stocks over the last couple of days. Looks like it might peter out tonight. But we've got yields coming down. A couple of weeks ago, we were talking about peak inflation and maybe trying to nibble into bonds and rotating your portfolio to reflect that dynamic. How are you currently sitting in terms of that view as far as portfolio allocation and where we're sitting in the market? Yeah,
look, it's really interesting, Kyle. I think one thing that I've noticed is the US cash futures market is now starting to price in rate cuts in 2023. So no longer is the futures market just pointing for higher and higher and higher cash rates. It looks like they're peaking out. So this chart here just shows that the June futures are pricing in 3.1% for Fed funds rate, and yet the September futures are 3.06. So we're actually pricing in a Fed cutting rate. So that to me is a little bit like the bond market, or inflation expectations. They're starting to roll over. So the market's starting to think maybe these cash rates are enough to cause a recession, and the Fed may actually have to retreat from over cutting rates. So from a portfolio perspective, if you have no long duration assets, you've got no tech stocks, you've got none of that, A, congratulations, you've done well, because those sectors have been horrible this year. But B, now is time to start adding them. So the bond market, the inflation expectations rolling over is telling you that. The 30-year Treasury, yield starting to come down is telling you that, and now the cash futures are telling you that. It's not a, ring the bell, buy the market moment, but it's time to start adding those things. And obviously the Snapchat result last night has hurt the tech sector again. Some of those stocks are starting to look pretty good value.